When you're investing in high yield stocks, it can be easy to be captivated by both the brand name of the company and its track record of growing its dividend payout, and then also look at the attractive yield that it currently offers and maybe even the credit rating for the company, and put all those things together and think, oh, this is a slam dunk buy. However, typically if a company that has been historically very high quality and has a dividend growth track record also trades at a very high yield at the moment, there's typically a very good reason that Mr. Market is doing that, and it's important that you carefully assess why and make an intelligent decision of whether or not you should buy it. And so in today's video, I'm going to talk about 3 blue chip dividend growth stocks that have plummeted recently, causing their dividend yields to skyrocket, and share my take on each of them and whether or not I'm personally buying them or not at the moment. Before I get into today's video though, if you like getting regular dividend content, whether it be individual dividend stocks like I'm going to talk about today, or dividend ETFs, or even CEFs, or dividend investment strategies and philosophies, and even model portfolios, please consider subscribing to my channel, because I put out regular content multiple times a week, and I try to create very high value for my viewers. So if you do that, I'd greatly appreciate it. Thank you very much. Okay, so what is the first stock I'm going to talk about today? Well, it's United Parcel Services, or ticker symbol UPS. Now, this is a global logistics giant. It has a near irreplaceable network of distribution centers, trucks, planes, employees, etc., that enable it to provide incredible amounts of volume for business-to-business customers, consumers, and other type scenarios all over the world, with a big focus, of course, on the United States. And it's operated for decades. It's built an impressive track record, again, an impressive moat. It's grown its dividend consistently year after year, and yet today it yields about 7%, which is very high. In fact, it's more than double its historic average dividend yield. It also trades at a very attractive price to earnings ratio and enterprise value to EBITDA compared to its historic valuation multiples. And so when you combine that with its A credit rating from the likes of S&P and Moody's, it looks like a slam dunk buy, right? A wide moat company with this irreplaceable network of assets, with an ability to handle a volume and a sophistication of logistics projects that very few other companies in the world can handle. It has a huge treasure trove of corporate proprietary data that it is and will continue to increasingly leverage in the age of AI to optimize its operations. It's already investing very aggressively in automation, starting to automate its distribution centers, will probably increasingly do so as the world increasingly moves to autonomous trucking and autonomous driving technology. It will be able to deliver packages extremely cheaply, either through autonomous trucks and or through drone deliveries. And so there's a lot to like here about UPS. I think over the long term positions it for success. Then you've got that strong balance sheet, you've got that attractive dividend yield, you've got that cheap valuation, you've got the dividend growth track record. In fact, the CEO on their latest earnings call emphasized that UPS's balance sheet and its dividend are rock solid, and it's firmly committed to both of those. And so with all those things taken into consideration, it seems like a slam dunk buy. Additionally, UPS is actually leaving its Amazon business, where it was doing a lot of the transportation for Amazon's packages and returns, etc., because it's such a low margin business that they're going to cut that back, try to reduce headcount, close some of its operating centers, and focus on growing its high margin businesses, including its efforts to grow in healthcare logistics. And the thought was there that they will significantly improve the profitability of the business and position it for long-term growth. Now, that does look rosy, especially combined with these other factors that I just mentioned to you. However, there's a reason why the stock is down so much recently and the dividend is so high. And that really is the fact that they are kind of stumbling in this transition period. Their exit from Amazon is progressing, but their ability to reduce costs commensurately with the decline in volume is lagging. They've not been able to reduce headcount as quickly as they had hoped. They are also just simply struggling with some of their algorithms that they had used to try to pursue some growth projects alongside. They're reducing their expenses, and that's not gone as expected as well. And so what they're dealing with now is higher expenses than they expected, along with the reduction in volumes that they did expect. Now, a big problem with reducing headcount is that their workforce is heavily unionized and it's very highly compensated. And so getting rid of these highly compensated unionized workers is very difficult. They're trying to do buyouts, not getting the expectations that they hope there. They keep pushing these type of offers for early retirement, etc. And it's just not happening quite the rate that they expected. So they may have to push more draconian measures, but of course then they run the risk of the ire of the union. So it'll be interesting to see how that plays out, but certainly the market is uncertain about that. Additionally, they're facing tariff headwinds because they do a lot of shipping of packages to the United States, a lot of smaller size, de minimis type packages from places like China and other countries overseas. And so as that loophole has been closed, those packages have seen a dramatic drop off in their flow. And plus just the elevated tariffs in the United States on imports from foreign countries has reduced their traffic. Additionally, there's uncertainty just in terms of the whole economic environment, how that's going to affect demand for their shipping projects. So combining the uncertainty with the Amazon exit and trying to downsize costs quickly with that uncertainty for the tariff outlook, they're not even able to provide guidance right now. And the market hates uncertainty with a passion. When you couple all that with the fact that their earnings per share currently are barely covering their dividend payout for the year, that creates a bit of an uncertain environment, an uncertain outlook for the dividend itself. In fact, that's what prompted the CEO on the last earnings call to reiterate that our commitment to our dividend is rock solid. Typically, when a CEO has to go out of their way to emphasize that the dividend is safe, that's not a good sign. It doesn't always mean it's headed for a dividend cut, but it means that the market is onto something when it's concerned about the dividend. The fact that the company has to go out of its way and say, oh yeah, don't worry, our dividend is safe. You don't hear truly safe perennial dividend growers having to go out and say, oh yeah, our dividend is safe. They just simply say, oh yeah, we're going to continue growing our dividend. So there is concern there, and I think it's well warranted. Certainly the value could be very real there. It does seem quite cheap for such a well put together logistics giant. And I think if they can work through these multiple headwinds in a fairly short period of time, not only will the dividend be safe, but I think we're going to see massive upside for the stock. Wouldn't shock me to see 50% or even more upside in the next few years in UPS stock, but there is risk. In fact, there is meaningful risk of a dividend cut if they fail on the Amazon transition with the cost cuts that they're trying for, if they can't quite achieve those, especially in combination with their heavy investments in automation, which takes some capex up front and trial and error up front, as well as potential headwinds from the tariffs and changing trade patterns. All those combined could push them to cut their dividend despite their strong balance sheet. And so we'll have to wait and see what happens. But for now, I'm personally staying on the sidelines with UPS. I'm waiting to see if they were to cut the dividend and right size it with a much larger margin of safety and the stock plummeted accordingly even further, I would likely be very tempted to take a position. Or if they show clear signs of working through these problems, and if for whatever reason the market doesn't wake up to that and it stays very heavily discounted, I would also likely consider buying then. But if it does recover sharply as they work through the issues and I miss out, that's fine with me. I have a lot of other high conviction opportunities that I'm invested in that I feel good about that offer similar yields to UPS. So I consider it I stay on the sidelines and I miss out, I'm still probably in good shape. The dividend gets cut and the stock plummets further, then I'm glad I didn't buy, and then I can scoop up the shares at an even lower price moving forward. The second stock that I'm going to talk about that sold off recently is Conagra Brands. Now this is primarily a frozen foods company. It also sells snacks, and it has just gotten bludgeoned recently, and that's due to primarily high input cost inflation over the past several years that have really pinched their profit margins. And the reason it's pinched their profit margins is that there's so much competition in their product categories with private label offerings, especially undercutting any kind of brand power that they have to be able to price at higher levels. Yes, they do have some brands that are recognized as leaders in various product categories, and perhaps that does get them some loyalty and perhaps even allows them to charge a slightly higher price than, say, their private label competitors, but not enough to be able to pass through higher inflationary input costs, including some headwinds from tariffs that they're suffering from right now. And so as a result, in recent years, their earnings per share have declined considerably. And even though they've been trying to pay down debt, because their earnings per share and their EBITDA have been declining so much, their leverage ratio has risen substantially. And so now they're faced with a situation where they're going to have to really focus on paying down debt aggressively. And that's what they're pointing to this next year. They're not planning to hike the dividend this year. They're just going to hold it stable and really try to focus on paying down the debt while also investing as needed to try to turn around the business and improve their margins. However, if their profit margins do not turn around, in fact, if they continue to suffer increasing pressures on both the sale pricing front as well as the input cost front, and their leverage continues to rise even as they pay down debt aggressively, they may get to a point where they're like, you know what, we're just going to have to cut the dividend. Now, the dividend payout ratio is under 80%. It's like 78% or something like that based on the expectations for this next year. So it's not at a critical point in terms of them just being able to cover it with earnings, but it's more the leverage ratio that concerns me at this point. It's gotten pretty high. And so we'll just have to wait and see what happens in this next year. But again, because of the weak growth potential, and yes, the dividend yield of about 7%, a little higher than that, is attractive, especially relative to its historical levels. I just don't see enough upside potential, even if the business recovers and returns to some kind of growth, that the yield is enough to really compensate me for that. So I want to wait and see, stick on the sidelines. If they cut the dividend, the stock falls further, or just the stock just falls meaningfully further and the dividend yield gets even higher, then I might be tempted to buy in. But right now, I'm just not compelled. Okay, so the third and final stock I'm going to talk about today is LyondellBasell. Now, LyondellBasell is engaged in making various like polyethylene products that are used in industrial products across the world, and so in plastics and things like that. So it does have an essential business. However, it is fairly cyclical, and this is primarily because companies do go through stocking and destocking cycles, from buying their products. Also, the state of the economy goes through cycles, and so when you have a stronger economy, certainly there's more demand. Weaker economy, certainly there's less demand. And on top of that, they are very input cost sensitive, and so when their input costs go up, that can obviously weigh on their margins. And additionally, they can't really pass a lot of those costs on because there are alternative materials that can be used to what they offer in some of the end-use products. And so there is a sense where if they raise their prices too much, then the end-use demand would go elsewhere and they would lose market share. Additionally, there is a lot of excess capacity in their industry right now. And so even though LyondellBasell does have some of the lowest cost assets in the world, whether it be in Saudi Arabia or primarily in the United States, they still are suffering from reduced profit margins. Now, the good news here is LyondellBasell has a very strong balance sheet. They have one of the best in the industry. They also have some of the lowest cost assets in the industry that helps preserve their profitability better. They have high cash conversion ratios, and they've been implementing a lot of measures to try to cut costs and conserve cash. And they have additional ones that they're still working on implementing. And so that's really helped them through this cycle, combined with their strong balance sheet, to where have they not cut their dividend, but they actually hiked it by about 3% earlier this year. And that contrasts sharply with a peer, Dow Inc., in their sector, which had to slash its dividend by 50% because of its balance sheet was getting stressed, and it needed to do that to be able to support the business through the cycle. And so LyondellBasell has been buying back stock and growing its dividend during this downturn, which has been great and helped it to significantly outperform peers like Dow. However, the stock has still gotten walloped. The dividend yield is sky high right now. It's around 9-10%. And so, things are looking really gloomy. And management even admitted that, this is the longest down cycle that they've ever experienced in their many decades in the industry. So it seems like, based on historical norms, things would turn up soon. And there are a few green shoots on demand side that are showing, but still no clear signs of an industry turnaround. And so, management is committed to that dividend. They still have some balance sheet capacity to be able to further support it. They can further dial back CapEx to some degree next year to further support the dividend, and they will implement those measures if needed. And so I think that there's a reasonable chance that they'll be able to sustain their dividend at least through the end of the year and probably into 2026 as well, barring some, economic downturn or clear indicators that the downturn is going to be extended well beyond 2026. And so we'll just have to wait and see what's going to happen there. But in full disclosure, I am long the stock because it trades way below the replacement cost of its competitively positioned assets. And so there is incredible intrinsic value embedded, hard intrinsic value embedded in the business. Its products are essential to the global economy. And so it's not just a matter of, I produce food products, but end-use food products, but so do a bunch of competitors. And if I go away, it's not a big deal. If LyondellBasell went away, it would be a major blow to the global industry, especially because it has some of the lowest cost assets in the world. And again, its dividend yield is even higher than the other alternatives of over 9%. It has an impressive dividend growth track record, has a good management team, a good balance sheet. And so I just see greater intrinsic value in these shares than in the other two. And I have higher conviction that over time, they're going to be able to turn it around because it's purely due to them being in a cyclical industry and a long duration cyclical downturn. Whereas, the food industry is being hit not because of a cyclical factor, but because of it's being hit by inflation, which shows no signs of abating. In fact, if the Fed cuts rates aggressively, like is expected it will, plus the tariffs really coming online in full force, that could further accelerate their problems. And UPS, again, has those tariff headwinds. It's having to do a very highly complicated industry move with its exiting of Amazon, it's trying to lay off unionized employees, et cetera, et cetera. That's not even accounting for potential impacts that a recession would have on it. Whereas LyondellBasell seems to have its operations in order and it's well positioned in its industry. It's simply suffering from a current cyclical matter. Now, again, it's still a high risk investment. I realize that it could very well cut its dividend in the future. So this is far from a back up the truck and load up on LyondellBasell. But if you're looking for an opportunistic, beaten down blue chip dividend stock, out of these three, I think LyondellBasell offers the most attractive risk reward. So there you have it. I hope you liked the video. If you did, please give it a like. That would really help in its distribution and mean a lot to me. And again, if you like content like this, deep dive analysis into dividend stocks, please subscribe to the channel for more content. Thank you very much and see you next time.